Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome to ETF Market Insights. I'm Danielle Nuzzle with BMO ETFs. Thanks so much for joining us today. Well, the Bank of Canada recently dropped their overnight rate to 2.5%. Just 1 year ago, rates were 5%. So rates have been cut in half in the last 12 months. So what do falling rates mean for equity markets and for ETFs? And as a reminder, today we are not providing you any investment advice. We're not providing you any investment recommendation. Today's show and our channel, it's all about providing information for the Canadian ETF investor to empower you to make the right decisions for your own objectives and investment goals. We have Tony Dong with us today. Tony is the founder of ETFportfolioblueprint.com. He is also an investment analyst for ETF Central, for Money Sense, and a contributor to other investment publications as well. Tony is going to give us some insight on which sectors may benefit from falling rates. Tony, it's so great to have you back on the channel with us.
Happy to be here, Danielle.
Well, we're going to get tactical with Tony today. So we want to know, Tony, let's open up your rate drop playbook. I'd like to know, historically, what sectors have outperformed when rates have been falling in a rate cutting environment. What have you seen? I always say history doesn't repeat itself, but it often rhymes. So what can you tell us about sectors and falling rates?
So the cool thing about that is that the 11 GICS sectors, they really haven't changed internally that much, with the exception of some like technology. So two of the ones that I'm looking at, utilities and real estate, they are very much still using the same business models as they were a couple decades ago. They borrow very heavily, often at floating rates for the short term or fixed rates for the long term. And once they have all that capital in hand, they use it to build the infrastructure that is expected to generate cash flow. So for real estate, obviously it's office buildings, retail buildings, multifamily apartments. And for utilities, you have power generation, like power plants. You have power transmission, like Hydro One, sending electricity across. You even have some nuclear ones. But they all share that interesting dynamic where they're very heavily reliant on debt. And thus, when they're issuing debt, when they're selling those bonds to raise that capital, where prevailing interest rates are for when they want to lock that in will play a big difference on their capital structure and also the types of returns that investors can expect.
Very interesting. So these sectors that use a lot of debt benefit from when that debt gets cheaper and rates start to go down. Okay, so the first sector you mentioned was the utility sector. We don't talk a lot about utilities on this channel. I think that sector is often overlooked by a lot of buy and hold investors who think of themselves as more growth investors. But we do see low volatility investors, those who want to take a little bit of equity risk, dial down their equity risk. You see them kind of looking at utilities from time to time. So what can you tell us, Tony, about investing in the utility sector right now? What can an investor expect from this sector?
So these stocks have been called widow and orphan stocks for a couple of decades now. And that's because back in the day, a lot of money managers realize that these are lower beta. They tend to fluctuate less because the operating structure is very interesting. They have a lot of that debt up front. And the way they can make money is in two ways. They can either hike their rates, which for many of these are regulated. There's a certain amount that the provincial regulator allows them to hike how much they can charge you for water, electricity, and gas each year. So that's kind of a cap on their growth. But moreover, the other way that they can grow is through the rate base. So utility might expand into a new plant, into a new area. There might be more people moving in the area, for instance, from immigration. So you have more hookups. So these are the two long-term growth drivers that we can expect. The other plus side is that while they're not required to pay out a significant portion of their cash flow, many utilities do, because the opportunities for them to reinvest those excess earnings into, like new development is less efficient than actually borrowing, especially when rates are falling. A lot of utilities executives, if they're smart enough, they'll realize this, which is why you see them giving that cash back to you as a quarterly dividend, sometimes monthly. And the mentality is that if we can't reinvest that money at a rate of return higher than our cost of capital, which for utilities is pretty high, it's better off in the pocket of shareholders to do as you wish. And some people reinvest them, but with the average utility in Canada offering yields north of 3%, that is now with the recent rate cut higher than what you can get from the risk-free rate. So we're seeing quite a bit more interest in that, especially as investors get more defensively minded, given that the TSX is once again at all-time highs.
Interesting perspective there. So you have a sector in the utilities who, instead of reinvesting earnings for growth, they're paying a lot of that out as dividends. We do see a lot of dividend investors often look to the utilities sector just for that reason. I will point out too that dividend paying sectors, they also like rate cutting environments because, as you pointed out, when rates go down, it's harder for investors to find monthly cash flows. So a dividend paying sector like utilities kind of fills that bucket for certain income investors. All right, Tony, you also brought up real estate. And this is an interesting sector because what we've seen is the housing market has been cooling off, yet the commercial space seems to be growing a little bit, or investors are a little more bullish on the commercial space than they were before, given all these return to office mandates. So what are your thoughts on this sector?
It's not very homogenous, not as people believe. People look at real estate as kind of this monolithic entity, but there is quite a bit of variation in it. For instance, you mentioned that the residential market is cooling down, and that is absolutely true. Single-family residential, especially condo prices, have slumped significantly in Vancouver and Toronto. You got a lot of basically people who bought these pre-construction condos, which is essentially a forward contract on real estate. It's highly leveraged, and they can't take assignment right now because they can't come up with the closing costs. And if you look at cap rates, which is your net rental income divided by your asset value, they're not that good. Whereas the yields on real estate investment trusts, for instance, with the various REIT ETFs out there, they're north of 4% and they're paid monthly. In addition, like, you're right that we're seeing a resurgence in commercial properties. However, the recovery has been slow because if you look at the occupancy rates of some of the major office real estate investment trusts, they are still struggling to recover above pre-pandemic norms. So it's not uncommon to see occupancy rates of some of the major office REITs of 85%, lower than 90%. And typically that's when you should be a little worried, because when occupancy rate is low, it means that they're not efficiently using all the space they have, and thus rent incomes are lower than average. That flows through into what we call a lower funds from operation. So REITs don't report earnings like normal stocks do. They use FFO, which is funds from operation. It gives you a more accurate picture of the cash flow because it accounts for items like depreciation, amortization. But back to that topic, we see that for these commercial offices, it is still really a bit of a struggle. And I think that the recovery has been slower than what investors have expected. The upside of it is that commercial real estate investment trusts are still undervalued on a funds from operations basis compared to their other peers like retail and residential, and also the broad sector as a whole.
So investors might be looking to the real estate sector for kind of like a valuation play, also maybe that dividend play when we're seeing rates go down. So you mentioned REITs, real estate investment trusts. For investors out there who are watching this that might not be very familiar with REITs, Tony, number one, how can an investor access a REIT? And what are these and how can they add them to investment accounts?
Sure. So a REIT is a special type of public company that has a mandate to invest substantially most of its assets in real estate. In the US, there's a rule that they have to pay out 90% of earnings, but in Canada, no such thing exists. But you still see most of them will have a high payout ratio because the goal is to provide you with a liquid listed vehicle for real estate investments. Now, there are private REITs. We're not going to get into those because they can have issues when it comes to redeeming shares and also freezes. But public REITs span all of the major real estate subsectors. So you have the ones we mentioned, the commercial office REITs, you have the residential, that can be single family or multifamily, which is most common. You have retail, which can be anything from groceries to shopping malls, and you have industrial. And with e-commerce, we've seen a lot of ones that we call 3PL, which are the logistic operators that Amazon and so on will be tenants of to move all their products. Now, you can access these individually. They trade on various exchanges, most notably in Canada, the Toronto Stock Exchange. And a good way to identify if it's a REIT is that sometimes at the end of it, they'll have a .un suffix. And that just tells you that it's an investment trust and not a typical corporation. There's a few more out there that are more income trusts and they don't own real estate, but it's largely the similar idea. And of course, like any listed liquid security, you can put it in the ETF wrapper and you gain the usual benefits of diversification, which is especially important if you're investing in real estate because you don't want to just be concentrated in a handful of buildings in, say, metropolitan Toronto, right?
Absolutely. So ETFs bringing REITs directly to investors. Investors don't have to research which REIT they would like to buy. That would be a difficult process for sure. And instead can kind of take that top-down approach on the sector, purchase an ETF like BMO's ZRE. Same with the utility sector. We say for tactical investors who would like to make a more active play in their investment portfolios, looking to a sector ETF can help them make a play in their portfolio. They have high conviction in that sector without having to do the nitty-gritty research on stocks, which we all know is really difficult to do, even for professional active managers. Okay, Tony, question, will lower rates persist? How long is this trade going to last? What is the current climate in Canada? Do you see these sectors like more of a longer term buy and hold? Or as we were discussing, is this just kind of a short term tactical move?
Forecasting macroeconomics is, to put it crudely, a crapshoot. We've had one rate cut, but the important thing is that we're nowhere close to the terminal rate that we've seen before. So the consensus I've seen on Bay Street so far is that we're looking at another 2 to 3 25 basis point cuts throughout 2020 for the rest of 2025 and 2026. And it's interesting to know that the Bank of Canada doesn't have the same dual mandate as the Fed does. The Fed is concerned with maximum employment and a steady long-term inflation rate of around 2%. The Bank of Canada doesn't do anything like that. They can be much more focused when it comes to their mandate. But they're also in a very tough place right now, given the ongoing trade war and worryingly enough, an uptick in some inputs. For instance, meat. You might have noticed that the meat that you're buying is more expensive, and there will be revisions to that. But my suggestion to viewers, as always, is that this is noise. It's important if you have a variable rate mortgage; it's good for you and that, but it's just one of many factors to consider before you consider an investment in real estate or utilities. For instance, if I was looking at this, the rate cut would be an additional variable that would make it a positive for me. If I was on the fence about allocating to utilities and real estate, Bank of Canada just cuts rates, and you read Tiff's comments, and he's talking about like being dovish on this. Well, maybe that's not a bad short-term tactical move. But even then, I find that these two sectors are very good at shareholder returns. They know that their growth prospects are limited and is very hard to achieve. You got to borrow more to build more of that infrastructure with the hope of capturing more people, with the hope of capturing more renters, hope of capturing more connections, whatever it is for them. So they will return most of their free cash flow to you. And given how much registered account room Canadians have these days in a TFSA, both of these are fantastic. And even outside of it, the utilities aren't bad because most of these are qualified. But I would caution viewers to be careful about real estate investment trusts in a non-registered account because the tax treatment of their distributions is not qualified. It's mostly ordinary income with some return of capital, and that can get quite messy.
That's a great distinction to make about the type of cash flow that's coming from these two different sectors. REITs is generally income, and utilities usually dividend income, which is more preferential treatment here in Canadian taxable accounts. So, great thing to highlight there. So Tony, with falling rates, we are seeing a lot of investors we're going into a risk on environment. So investors put a lot of money in cash, still a lot of money in cash because that was yielding like around 5% or even higher just a year and a half ago. We're seeing with dropping rates, this cash return grinding lower and lower. So investors are coming out of cash into a little more riskier things, into equity markets. Can you talk about this shift in investor psychology right now, and how does this play into the utilities and the real estate sector?
Yeah, sure. So I use this concept I called where it's a internal hurdle rate. So if I put myself in the shoes of the average retail investor, in 2022, when the Bank of Canada hiked rates a couple of times to stop inflation, you were able to get a more or less risk-free 4 to 5%, which is very attractive with monthly distributions, right? You're not taking a lot of risk. And during that time, what we call the equity risk premium, which is the additional return expectation you have for taking on that risk, wasn't very high given how high the risk-free rate was. But with it dropping right now, like even the yields on some utilities ETFs like ZUT or real estate ETFs like ZRE, it is once again significantly higher than the 2.5% you can get from something lower risk like ZNMK or ZST. And in addition, that comes with the potential for capital appreciation. With bonds, you're just banking on the short-term income. Like the prices aren't going to move that much, especially the short-term bonds that won't benefit when rates fall. In fact, you'll see the yield fall in lockstep with the ones under 1 year. But with the equities ETF, you have the potential for capital appreciation, especially in these, what I call these plain Jane products, where they're not using covered calls to increase the yield by sacrificing upside. You can actually retain a fair amount of equity appreciation. And I think year to date, the S&P TSX capped utilities and the capped real estate indexes have actually done quite well.
Thanks, Tony. So investors looking to move out of cash, obviously, the equity market carries more risk than cash market, than bonds. It is a different game for sure, but looking to low volatility sectors like utilities, like REITs, can lessen that equity risk within an equity portfolio. Also, with that income coming from REITs or those dividends coming from utilities, helping out these companies who take on more debt. That was very insightful, Tony. Thank you so much for joining us today.
My pleasure. The only thing I would add is, remember, these are still equities. You still have that risk. Lots of principles possible. And if you're going to focus on one sector, it pays to stay ahead of sector-specific risk. So for real estates, look at the occupancy rate. All the real estate investment trusts will disclose this on a quarter-to-quarter basis. You want to make sure it's not going lower. And for utilities, one part I will note is that there is a significantly higher risk of disasters and climate risk as they're compared to the past. So if you're going to invest in utilities on a stock-by-stock basis, look at where their rate base is, look at where the pattern of climate changes, if there's extra floods, if there's more windstorms, if there's more wildfires, and factor that in, because that's not a lot of forward-looking people do that. But again, if you don't want to deal with that and you just understand that the sector in itself has its own risk, an ETF lets you skip a lot of that due diligence.
Thanks for telling us about those metrics. And yes, ETFs bring that diversification to the table, which is one of the benefits we love from using ETFs. Tony, it's great to have you on the show today. Thanks for everyone who is joining us, and we'll see you next week.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.